What if everything about building wealth is backwards? Marc Andreessen proved it with a browser built in a university lab that helped kickstart the modern internet, and later, with a venture firm that backed platforms used by billions. The path wasn't linear. It defied precedent. And it still shapes the playbook for the builders of today. There's one decision Marc Andreessen made that changed everything. Most people never see it coming. Marc Andreessen was born in 1971 in Cedar Falls, Iowa, and grew up in New Lisbon, Wisconsin. Public school. Midwestern upbringing. An early fascination with computers that didn't look like a future empire at the time. According to Britannica and other biographical records, he taught himself programming as a teenager, then studied computer science at the University of Illinois at Urbana-Champaign. The campus setting matters because of one lab, the National Center for Supercomputing Applications, or NCSA. The Internet existed before Andreessen. But it didn't feel accessible. It felt technical, distant, something for researchers and defense networks. In 1992–1993, as an undergraduate working at NCSA, Marc Andreessen and Eric Bina co-authored a software project that changed that dynamic. It was called Mosaic. Public Records and Contemporary Reporting credit Mosaic as one of the first popular web browsers to combine images and text in the same window, with a user-friendly interface that made navigating the web intuitive. As reported by the New York Times and Wired, this wasn't just another piece of software. It was the on-ramp. Why that mattered is simple. The web needed a usable interface to go mainstream. Mosaic lowered the friction. It wasn't the only browser, but it became the standard people could understand. The pivotal moment came after Mosaic's release. In early 1994, Silicon Graphics founder Jim Clark saw what was happening and reached out. Clark wanted to build a company around the browser vision. According to reporting from the period, the new venture started as Mosaic Communications Corporation, then quickly rebranded as Netscape Communications, after legal concerns around the Mosaic name. The leap from a university project to a commercial browser company was the first major decision that would define Marc Andreessen's trajectory. The skepticism was immediate. The idea that a small startup could commercialize browsing the web when major tech companies either weren't paying attention or were delivering complex tools seemed audacious. There were questions about whether the web would ever be used by mainstream consumers. There were questions about business models. And there were questions about competition, especially from giants like Microsoft. But Netscape had something precious: timing. The web was on the edge of exploding. Netscape Navigator, released in late 1994, made the web navigable. The distribution model, downloadable software, cut out barriers. Word spread. The contrarian insight was that access beats complexity. A simpler browser could create a larger market than a more powerful but clunky one. The team bet that the Internet's future would be about ease and speed. And the market rewarded that bet. On August 9, 1995, Netscape went public in a headline-making IPO that symbolized the dawn of the commercial Internet era. According to the New York Times, shares priced at $28 and closed at $58.25 on the first day, valuing the company in the billions and sending a signal worldwide. The web was not a niche. It was the next platform. In less than 2 years, Marc Andreessen went from a college lab to the face of a browser company at the center of a new economy. The breakthrough wasn't only technical. It was strategic. Build the on-ramp. Grow the user base. Let the network take over. That was only the beginning. But Marc Andreessen was about to make a move that would change everything, because early success brings competition, and competition forces reinvention. The browser war was the proving ground. Microsoft recognized the stakes and launched Internet Explorer, bundling it with Windows. The competitive pressure was immediate. And it reshaped Netscape's future, the industry, and Andreessen's next chapter. Andreessen's approach to the breakthrough can be distilled into a pattern visible across his career. Identify the platform shift early, build or back the critical layer, and move at startup speed, even when incumbents mobilize. At Netscape, the browser was the layer. At the University of Illinois, Mosaic proved demand for usable interfaces. With Netscape, the team converted that demand into a market. The first major wins, user adoption, developer mindshare, a landmark IPO, validated the approach. But competition from Microsoft escalated quickly. The Department of Justice later filed an antitrust case against Microsoft in 1998, citing, among other issues, the bundling of Internet Explorer with Windows. According to the DOJ's case filings and contemporary coverage, Netscape's market share fell as Microsoft leveraged distribution. This period taught a few durable lessons. First, speed compounds. Second, platform control matters. And third, adaptability is non-negotiable. Netscape sought ways to maintain relevance. Servers, enterprise software, standards influence. But the gravity of Microsoft's desktop distribution was immense. In November 1998, AOL agreed to acquire Netscape, in a deal valued at approximately $4.2 billion in stock, as reported by the Wall Street Journal and the New York Times. For a founder in his 20s, this was already a career many would consider complete. But the path forward would expand from building products to building companies that enable other builders. In 1999, Andreessen County founded LoudCloud, with Ben Horowitz, Tim Howes, and In-Sic Rhee. The idea: provide infrastructure and services to run Internet applications. What would later be known as cloud computing. LoudCloud went public in 2001, then navigated the dot-com crash by pivoting. The services business was sold. The company focused on its software, renamed Opsware, and rebuilt. According to public filings and press releases, in 2007, Hewlett-Packard acquired Opsware for approximately $1.6 billion. This wasn't luck. It was a demonstration of strategic flexibility under extreme pressure. The contrarian insight, when the market flips, change the business to match reality, not the plan. By 2009, a new kind of institution entered Silicon Valley, with Marc Andreessen and Ben Horowitz's venture capital firm, Andreessen Horowitz, known as A16Z. The thesis was explicit. Software would continue to transform every industry, not just tech. The firm would back those founders and surround them with the kind of support traditionally unavailable to early-stage companies. The rationale was captured in a 2011 Wall Street Journal essay, authored by Marc Andreessen, titled, "Why Software is Eating the World." The argument: software-driven companies were poised to dominate large swaths of the economy, because software was a lever that scaled. It was a public articulation of a thesis that the firm would invest behind for the next decade. Early portfolio bets validated the approach. Andreessen joined Facebook's board in 2008 before founding the firm. A16Z later invested in platforms like Airbnb, GitHub, Skype, Oculus VR, and Coinbase, among others. According to the New York Times and firm announcements, A16Z led GitHub's $100 million Series A in 2012, one of the largest first rounds at the time, betting on the developer ecosystem as a platform. Microsoft acquired GitHub in 2018 for $7.5 billion, as reported by Microsoft's press release. Oculus VR was acquired by Facebook in 2014 for approximately $2 billion in cash and stock, as reported by Facebook. Skype, invested in by a group including Silver Lake and with a 16Z participation, reported in the press, sold to Microsoft in 2011 for $8.5 billion. Coinbase went public in 2021 with a direct listing. Regulatory filings show a multi-billion-dollar valuation on the first day of trading. The pattern that emerged wasn't accidental. It was systematic. Platform bets with wide moats, networks that grew stronger with each user, and software layers that could touch entire industries. But success was about to attract unwanted attention, because momentum in technology invites scrutiny, downturns, and narrative whiplash. Every empire story has a crisis chapter. For Marc Andreessen, several moments tested judgment and resilience. The first true trial arrived during the browser war. Netscape's fast start met Microsoft's distribution advantage. The stakes were existential. It was not simply about winning market share. It was about surviving long enough to matter. Netscape's sale to AOL was a resolution, but also an acknowledgement that strategy must adjust when platform dynamics are against you. Public records and reporting from the era captured a tumultuous landscape where startups could be outmaneuvered by bundled distribution. The second test came with LoudCloud. The dot-com boom had raised expectations. The crash brought reality. LoudCloud's pivot to Opsware required difficult decisions: restructuring, selling off parts of the business, and refocusing on software. According to public filings, this wasn't a smooth path. It required leadership under pressure and a clear-eyed view of what customers actually needed. The eventual $1.6 billion acquisition by HP showed what disciplined execution could salvage from a collapsed market. The venture chapter brought its own volatility. Technology investing is cyclical. There were periods, crypto winters, public market drawdowns, and changing sentiment, where the thesis that software would keep eating the world looked either obvious or under fire, depending on the quarter. According to CNBC and other financial outlets, Andreessen Horowitz raised a $4.5 billion crypto fund in 2022 during a period of heightened skepticism. An explicit bet on the long-term potential of a technology cycle, with deep, short-term volatility. Public scrutiny intensified as the firm's influence grew. Investments in social platforms, crypto networks, and emerging technologies drew media attention and debate. As reported by Forbes and the Wall Street Journal, debates over regulation, market power, and societal impact became part of the background the firm operated within. The challenge for a public figure like Marc Andreessen continued to underwrite category-defining bets, while navigating an environment in which technology's role is both celebrated and contested. There was also the personal bandwidth challenge of scaling from builder to board member to firm co-founder. Serving on Facebook's board from 2008 to 2018, as noted by Facebook's announcements and reporting, meant participating in governance during one of the most scrutinized periods in tech history. Board work is rarely visible. Decisions matter more than headlines. And stepping down in 2018 marked the end of a decade of board service at the company. What emerged from these challenges were enduring lessons. The first, platform shifts are the tide, companies are the boats. The second, adaptive strategy beats fixed plans. The third, long-term theses survive news cycles. Execution determines whether they pay off. The outcome was far from certain in each case, but what happened next surprised everyone, not because of luck, but because of compounding. The Empire chapter is less about a single company and more about an architecture of influence, products built, companies steered, and a venture firm designed to scale founder outcomes. Andreessen Horowitz grew into one of Silicon Valley's most prominent venture firms. According to CNBC and the firm's own statements, A16Z manages tens of billions of dollars in assets, reported at over $35 billion in recent years, and invests across seed venture, growth, bio, fintech, gaming, and crypto. The model introduced operating support at scale, recruiting help, market development, regulatory navigation, and technical expertise, all delivered to portfolio companies, as if the firm were a platform itself. The portfolio outcomes formed a pattern across categories. GitHub, the developer platform, whose $100 million Series A in 2012 marked a new scale for early venture rounds. Acquired by Microsoft in 2018 for $7.5 billion. Oculus VR, a bet on immersive computing, acquired by Facebook in 2014 for approximately $2 billion. Skype, part of a consortium investment pre-acquisition. Microsoft purchased Skype in 2011 for $8.5 billion. Coinbase, a foundational crypto company, went public via direct listing in 2021. Airbnb, a marketplace that redefined travel. A16Z participated in early funding rounds as reported by the New York Times and other outlets. These are not exhaustive, but they illustrate the firm's bias. Platforms, networks, and software layers that sit where adoption compounds. Marc Andreessen's public thought leadership reinforced the thesis. The 2011 Wall Street Journal essay, "Why Software is Eating the World," framed a decade of investing. In 2023, a lengthy essay known as the Techno-Optimist Manifesto, published on the A16Z site, advocated for a forward-leaning bet on innovation and growth, arguing that technological progress expands abundance and improves quality of life. Whether one agrees or disagrees, the through line is consistent. Pick the platform shifts early and build behind them. The compounding effect is visible in the firm's structure. Each successful outcome, an acquisition, an IPO, a company achieving global scale, creates knowledge, credibility, and networks that feed the next generation of investments. Founders see past portfolio companies as case studies. Operators join to teach and recruit. Regulators and policymakers engage as technology moves into every sector. The feedback loop tightens. According to Forbes, Marc Andreessen's net worth has been estimated in the billion-plus range in recent years, reflecting the outcomes across founding, board service, and investing. But the more interesting measure is institutional. A firm with broad reach, a portfolio that touches everyday life, and an intellectual framework that predicts where value will pool as software continues to permeate the economy. The Empire is not just a fund. It is a thesis, with operational capacity. But here's what this actually means for anyone watching: the path is repeatable in principle, though not trivial in practice, and the lessons apply beyond venture capital. A few core principles emerge from Marc Andreessen's journey. First, platform shifts create new empires. Mosaic and Netscape rode the early web wave. Cloud anticipated cloud infrastructure. Andreessen Horowitz scaled on the idea that software would expand into everything. The principle is transferable. The next platform shift, whether artificial intelligence, synthetic biology, or something still invisible, will anoint new winners who position themselves at the right layers. Second, usability wins adoption. Mosaic and Netscape thrived because they made the web accessible. The companies, backed later, GitHub for developers, Airbnb for hosts and travelers, Coinbase for crypto users, each lowered friction in their categories. Builders looking for leverage should ask, what interface makes the next capability mainstream? Third, adaptability protects compounding. Netscape faced a distribution squeeze. The outcome was a sale. Cloud faced a macro shock. The response was a pivot to Opsware and a later acquisition. In venture cycles, the firm doubled down on long-term theses, even in difficult markets. The pattern is to update strategy while staying faithful to a durable worldview. Fourth, institutionalize advantage. Andreessen Horowitz didn't just pick companies, it built a service architecture to help them succeed. The lesson for any operator is to turn individual excellence into systems. Recruiting pipelines, knowledge bases, relationships that multiply across projects. Fifth, ideas matter. The 2011 essay in the Wall Street Journal was not merely marketing. It was a map. Statements like the Techno-Optimist Manifesto, agree or disagree, clarify a stance and attract aligned founders. Builders, who articulate a clear thesis, can pull complementary talent and capital toward them. Why it wasn't just luck or privilege is embedded in the repeated pattern. Early identification of platform shifts, speed to build or back the right layers, willingness to pivot when reality changes, and the operational discipline to institutionalize what works. What's required to replicate, at any scale, is a combination of mindset and mechanics. Mindset: optimism about technological leverage, skepticism about static plans, patience for compounding. Capital: enough to play in your chosen arena. This can range from sweat equity to institutional funding, but the discipline is the same. Allocate to high leverage layers. Knowledge: understand the stack you're betting on. In software-based markets, this means product sense and distribution insight. Execution: hire well, ship fast, measure, and iterate. Build systems that survive beyond a single win. Modern applicability is high. The playbook travels into AI, fintech, bio, climate tech, and beyond. The lesson is not to copy the surface details of anyone's success. It's to internalize the structure. Platform right pointing arrow, layer right pointing arrow, adoption right pointing arrow, institution. Here's what most people miss. The headline moments, the IPO pops, the acquisitions, and the essay titles are artifacts. The engine beneath them is a way of thinking about leverage, timing, and scale. That engine is available to anyone willing to study the stack, place deliberate bets, and persist through cycles. To fully understand how Marc Andreessen did this, there's a pattern. A strategy hiding in plain sight. The Forbes 400 know it. They exploit it. They've built fortunes with it. It breaks down into 4 proven deployment methods the Forbes 400 used to multiply wealth systematically. First link in the description. Watch it next. 10 minutes, that could change everything.